Welcome to Code and Concrete, the leading podcast for prop tech, conversations about the built environment, and other exciting innovations. If you learn something new, please consider following and leaving a positive review. Enjoy. Hi everyone, welcome back. Joining me today in the studio is Jens Bezuidenhout. He's originally from South Africa and began his finance career in Sydney. He's an accomplished entrepreneur and investor with expertise in blockchain, DeFi, and real estate, some of my favorite topics. He's a former Citi Group investment banker from London, or in London. He specialized in derivative risk management. He's got over 20 years in property development across the UK, Spain, and now leads LANDHIVE from Zurich, driving innovation and growth with his financial expertise. Jens, thank you so much for coming to Code and Concrete. Very excited to have you.
Matthew, thank you very much for having us. So you gave a pretty detailed introduction. Like I said, South African. My career spans very much the investment banking, and specifically I was in derivatives in London. But my passion was always, I think I was a frustrated architect, so I wanted to get into property. So I went from the finance side to the property development side, which I'm still actually physically involved in. And LANDHIVE was born from a desire, actually from a perspective of a property developer going through a period where we couldn't get liquidity, we couldn't sell the assets, the actual apartments.
Right.
And then we were being held to ransom by the banks, the commercial lending banks. So I was always interested in the idea of fractionalized investment, the old idea of 10 mates getting together and buying a house together. And, from that perspective, it was always an interesting idea, but the actual mechanics of it never worked. And then, of course, blockchain came along and DeFi. So from that, I explored ways that asset owners, in this case, property developers, could raise liquidity without actually having to sell the asset in this case. And on the other side, global investors being able to access previously very difficult investment opportunities. And hence, that's how we created LANDHIVE.
So let's unpack that journey a little bit. You went from capital markets to real estate, or maybe vice versa, depends on the order, and then eventually found yourself in DeFi. When did you first stumble across blockchain, and what about it felt so interesting or so relevant to your expertise already?
I think what's interesting here is if I go back and put my banking hat on, okay? So if you look at from a capital markets perspective, real estate is illiquid actually almost by design if you're looking at it from that perspective. If you're looking at physical assets, they're determined by the jurisdiction. There's a lot of manual processing and there's a lot of friction, transaction friction, which, you have intermediaries from lawyers to notaries. But from that perspective, it's a difficult asset to access for everyone. Those that are within the class and that can afford that friction and that process, they've benefited from that. What was my journey from capital markets to real estate to blockchain? It was trying to look at how we could, first of all, reduce that friction, how we could create access, and how we can raise liquidity. So from that journey, that's how we got to where LANDHIVE is. To unpack that a little bit more, though, I spent about nearly a year working with lawyers, looking at regulatory issues related to this topic that we're looking at. Mm-hmm. And I think what's kind of interesting here is, from a capital markets perspective, real estate is almost like where a fax machine, it operates like a fax machine from a tech stack perspective. And then DeFi is digital rails. So how do you bridge those two? And that's why I got interested in blockchain. So I don't know if that answers that question, but what I wanted to do as well is, with my banking hat on, I was in risk management. We were looking at companies wanting to protect against interest rate increases, as an example. So if you look at the actual underlying there, you're looking at a company with a loan that is an interest rate loan, and you've got another company on this side that has got a fixed rate loan. And these guys would say, okay, if you go back to like 1980s, they went and said, okay, well, how can we swap our loan commitments without actually transferring the loans? So that was the beginning of what you would call the swap market. So why is that interesting? I was in the derivatives section, so we would be structuring hedges where we would, go to one company and say, you want to fix your loan here? This is how you're going to do it. So you can go to the market and you can hedge that loan. But actually, if you break it down to its basics, it was really you needed two people, one company A and company B, to swap that commitment. So if we look at where real estate is now and all this conversation about bringing real world assets into the digital world, you have to ask, how can that happen without a standardized way, a standardized unit that everyone can reference or that everyone can price? Now, it worked in the swaps market in the end because they came up with a standardized contract. They looked at a standardized approach to risk and credit. And they then also had market makers who could say, okay, whatever, if you want to fix the loan or if you want to go on a floating rate, I will make you a price for that. So where real estate is right now is we're stuck somewhere in the 20th century. Blockchain and the DeFi component of blockchain gives it the digital rails to do it, but there's a lot of hurdles to get to that point. And that's, I thought, would be quite interesting to unpack for this and, various other questions.
Certainly. First, I want to touch on the standards component because I talk about standardization a lot, and it really lacks all throughout the real estate stack. So the underlying property itself, how they're built, how they're operated, how they report, and then the capital stack above that. And the financial instruments and the smart contracts, we don't have standards anywhere through it. And so you have a house of cards that's being built on a foundation of sand, meaning to say that it can be quite wobbly in the end. So where do you think that we could or should start to introduce standards throughout this process so that an asset class like real estate can make the most of DeFi rails?
Okay, well, that's a really interesting question because when I went through that 12-month regulatory process, what the point with physical assets, real estate, you cannot separate the actual asset from the land registry at this point. So you still need to, if you want to change the ownership, there needs to be a change at the land registry office in the equivalent jurisdiction. That means even if it's in the name of a company or if it's in the name of an individual, that has to be recorded, physically recorded. So that's on the one side. So if you now go and say, okay, well, we want to fractionalize this and we want to turn it into 100 shares and we want to tokenize that and we want to sell it. That's all well and good, but if you take that token and you trade it with somebody else, or if you sell the token, you still need to change the registration, the land registry, in the name of the company or in the name of the person. So tokenizing a share in the ownership of the asset at this stage doesn't work because we don't have, first of all, digital registry of asset ownership. And we also don't have a standardized legal form for that. And then thirdly, we don't have a hedgeable, tradable market that we could actually hedge that. Now, what does that mean? This journey where we got to is we said at this point in the process, to say that you can tokenize a share in the ownership of the asset, first of all, hits a huge amount of regulatory hurdles, especially in Europe and in the UK and in the US. And secondly, you have this issue that You cannot change the ownership without changing it online. What you can do, and this goes back to my derivative days, is you can build an on-chain yield layer, and that yield layer is actual rental payments. These are physical rental payments from people living in the building in professionally managed assets that can be exchanged. Where this works and where we can standardize is we say, okay, for example, LANDHIVE, we focus on the property development that we did, short-term managed rentals, professionally managed, suitable for holiday and business lets. Okay, so you have a specific rolling contract, specific returns higher than normal rentals, professionally managed. So what we do is we said, okay, fine, if that's the case, you as the investor can come and buy a share of the economic benefit of those rental streams. So if we put it back to my analogy before, where we have a company A, company B with a loan trying to swap their interest payments, we now have building A and building B, and building A and building B are sitting in similar cities, London and Madrid, similar values, similar returns. These buildings are generating rental returns. The investors in those tokens will receive that rental return every month according to the smart contract, and that's paid out. Same with the building in Madrid. So if we get to a point where we can standardize the asset, and we verify the assets, the actual transfer of value in terms of the rent as a contract can also be standardized. So from that side, we looked at it, and there's a lot going on here, but we partnered with Block Square out of Luxembourg. Now, what Block Square went through a long journey starting in 2017 and came to the same place that I did, which basically said, we need to look at transferring economic benefit. How do we do that? And is it regulatory compliant? First answer is yes. But what you need to do is you need to take it one step further, and you need to anchor the actual token that the people are buying to the asset. And that's where this is different. So in our case, we have the owner of the asset has to sign a corporate resolution saying that they will repurchase the tokens at the same price that the tokens are issued at when they sell the asset. So what does that do? It gives the asset owner, in this case a property developer, liquidity while they're looking to sell the asset down the line. And the actual owners and purchasers of the tokens get monthly rental streams. And they can either hold it, or they could look at the option of staking it if they want to increase their yield, or they can look at trying to sell it on the secondary market. And this is another large conversation. So I don't know if that gave you a bit of clarity there, but the next conversation is the illiquidity of the secondary market and how that impacts this, which is key.
Right. And Dennis was on episode 32 of Code and Concrete. So folks who are interested in the topics here, highly recommend going back to that episode and giving it a listen. Very insightful. Well, we'll talk about liquidity in secondary markets in just a moment. There's lots of complexities there. I still want to call back to your experience in what we call TradFi. And I want to ask, is there anything that you think must remain from TradFi as we go into DeFi? We're starting to make this transition. There's a lot of new characteristics of the digital instruments that we're creating, but we should not throw out the baby with the bathwater, as the saying goes. You don't have to dismantle the entire system. So what do you think are some of the elements that we do have to hold on to as we complete this transition in order for DeFi markets and tokenized assets to be successful?
Yeah, I completely agree with you, Matthew. If I want to use this as an analogy, you don't want to replace the building. What we're trying to do here is we want to upgrade the plumbing and the wiring. So TradFi brings legal enforceability, property rights, investor protections, regulated compliance. These are not hurdles. These are safeguards. Okay, so if we want to look at it from that perspective, now what is wrong with it? Well, it's clearly outdated in the way, and this goes back to my fax machine analogy. We're sitting in a situation where you've got manual reconciliations, you've got way too many intermediaries, you have settlement processes that, I mean, in the US at least it's a lot faster, but in the UK, the settlement process could sometimes take 3 to 4 months if you're trying to physically buy an asset. And then the other thing is you've got capital locked in these structures that you cannot easily release because of all of that. So what is DeFi doing is it's replacing these intermediaries with a transparent system, but it needs trust. And this is the whole point here, is that how do you build trust in the TradFi market? And here we're looking at institutional and high net worth investors to make the leap into a digitally compliant system where they are no longer relying on all these intermediaries, but they're actually relying on the infrastructure that we're building. And that's key. So I think in summary there, we need to bring all of the elements of TradFi that are related to the safeguards, but we need to bring everything related to the digital rails of DeFi to move this forward. So, if we're going to say that's a pretty broad version on this, if that gives you some clarity there.
Well, I agree. I think that too often people try to use DeFi as a way to get away from investor protections, from standards and regulatory guidelines. But those exist for a reason. They did not emerge overnight for the sake of surveillance. They exist because there is trouble in finance. And so we do have to preserve that. I think that turning the focus of blockchain or decentralized ledgers in general towards efficiency, trust between parties, and reducing that counterparty risk, auditability and traceability of different elements, whether that's information about the underlying asset or the instrument that's correlated to that asset. That's where I think the real value is. Because if we talk about why it can take 3 to 4 months for assets or instruments to settle, the reconciliation process is so extended because you are constantly reviewing and repeating due diligence and ensuring that everything is absolutely perfect before we settle and can achieve finality. So if we can accelerate that process, like that as the common denominator, like data symmetry almost, that seems to be one of the most cutting edge use cases for blockchain.
Matthew, exactly. I think a part of that process, if we want to focus on actually transferring ownership in a fractional context, we need to have some kind of digital representation of the actual title to do that.
Digitally native, you mean?
Yeah, digitally native. So it needs to be, if I'm sitting in Switzerland, that it's a digital registration in Switzerland of that asset. Mm-hmm. And then you can, if you take that, that there's a reference to the digital ownership. You can go to land registry, and from that basis, you could create a token and transfer it and change it digitally. You cannot cut out the intermediaries if we're still physically having to go and register this through the lawyer and a notary on that. That being said, and this is why I said, I think there's stages to this. And this first stage where we're effectively like the derivative stage with swaps, we're now bringing in the ability to swap cash flows. That's what rental yield is. And if you go to traditional securitization that was done and, to negative and positive effect, the only way you could securitize rental streams on big buildings was they standardized the buildings, they standardized the contracts, and they standardized the actual valuation of the instruments. So we're not there yet with RWA and the tokenization process, but I think this is going to move very quickly. I was just looking today. Bed Bath and Home in the US was buying a tokenization platform, and they want to get into mortgages.
I have a
So
question about that because I saw the headline that Bed Bath &
yeah,
Beyond was purchasing, and I thought that's so unrelated to what they do. That must be some sort of hiccup. What's happening there?
well, I looked at it as well, and I was going, well, what are they trying to do there? And
Mm-hmm.
and if you look at it, it's not going to work unless they. And I looked at the article. Unless they get the distribution, the compliance, and the liquidity, what are they going to try and do here? They can't issue these tokens with mortgage-backed securities. They can't go to a small investor and say, do you want to buy a token in this mortgage? But what it's saying is that, and they're not even large institutions, they're not even a BlackRock, that if that kind of institutional interest is moving into the sector, this sector is going to move forward quite quickly. And it will move forward when they get the distribution, the compliance, and the liquidity right. This, I think, brings us to liquidity. This is kind of my bugbear right now because everyone's saying, okay, you can issue these tokens and there's liquidity. Until we have enough flow through the sector of these asset-backed tokens, and until we have a regulated marketplace where a bid offer is actually put into the system where Matthew, can come with your token and you can offload that token within the marketplace, and you can get either another token or you can get fiat or stablecoin paid back to you. We're not there, but I reckon with the liquidity flows moving in terms of the Bed Baths and Beyonds, the BlackRocks, as they're moving in and they're starting to standardize flow. So if they mostly go in and they're looking at these mortgages, they're mostly looking at a pool of houses that are all very similar, that have a similar rental stream. And from that, it's traditional securitization. They're going to take those rental streams, they'll issue a bond, and they'll tokenize that bond. So if you're looking at where is this going, it's going debt tokenization. So being able to go in to a developer and say, we will fund your development and we can issue tokens and we can attach a token to that, is a simpler way to do this than actually saying, I want to go in and buy a share of the actual development. So that gives you a bit, from my perspective, that's where we're at with this. And that process might take another 12 months. It might take 2 years, but it's going to happen quickly.
Mm-hmm. Well, let's talk about investing into projects. This is something that you're very passionate about. What do you think has to change legally, technically, or even culturally before we see a lot of buyers, and that could be small or large, entering the scene, looking to get into these projects, diversifying their portfolio, but specifically in tokenized assets as opposed to the realty moguls or fundraisers or funders that exist today?
Yeah. If we look at it from a small and a large investor perspective, the on-chain infrastructure doesn't remove risk. So all we're doing is we're removing friction. So for a small investor, look at a small investor. What is his biggest issue? He doesn't have enough money to buy the asset. The ticket size is too large. He maybe doesn't have access to that asset because he's not geographically located or he's not in that club. And then thirdly is trust again. He doesn't trust the asset potentially, or the seller of the asset doesn't trust the buyer. Now, for the larger guys, it's a different process. Tokenization there would allow them to access professionally managed assets, and say for a family fund, let's say look at a family office, these guys usually have X amount of allocation, and then they would normally have to go and invest with one project or one fund. If there was a series of verified tokenized investment funds that are linked to specific assets, they could distribute that across those various funds. And from that side, it would be with transparent ownership because you've got the blockchain for the smart contracts. So for the larger guys, I think it's speed and flexibility, and for those struggling to reallocate capital. But for the smaller guys, this is about trust. They need to be able to. This is a slight segue, and I'm a banking property guy. I'm not a marketing guy. But when we started looking at Web3 users and said, okay, the Web3 users, these are guys are dynamic. They want to take control of the process. There's a lot of interaction, and they're digital. So these guys would naturally buy these tokens. But even if you go through this whole process, they're still in a situation where they say, well, if I'm going to buy the token, how am I going to be able to get my money back? Or will I get the monthly rentals? Now, that can only happen once we actually show that that's how we're doing it. But these guys, if they don't have the trust that this infrastructure will allow them to actually get their money back, or that there's some kind of protection, it's not going to grow the way it's going to go. So this goes back to traditional finance investors. And this back to my other conversation is the family offices, the high net worths, or even the savvy investors, they're going to be the same one. They're going to say, well, okay, if for me to do this, I need to trust the entity that's doing it. I need to understand the system, and I need to know how I'm going to get paid.
Well, that really answered the question beautifully. It did bring up one extra point, which are Web3 investors, which for some reason we sort of put as an outside category from the traditional retailer or institutional investor. So how do you think that an opportunity like tokenized real estate or tokenized yields of real estate, how that can be marketed to these Web3 investors? I'm sure many of them are tired of token crashes. They certainly like the benefits of the blockchain-based assets, but so many of them are being rug pulled, or even in instances where they think that they have some stability. If there's some sort of crash and the Ponzi scheme-like payout stops, they're still out. And I mean, a lot of people are looking at Michael Saylor, and although MicroStrategy isn't tokenized itself, still the concepts that if Bitcoin goes up, then we'll have enough money to pay people out dividends. And usually yield-based products are supposed to be more reliable, and even that could be unreliable if the price of Bitcoin goes down further. So how do you think that these investment products that we're shaping up, or that LANDHIVE is shaping up, could be attractive to potentially very exhausted Web3 investors?
I mean, Web3, basically memes and speculative and chasing DeFi yield has burned trust very early in the Web3 sector. And I think the other thing was there was way too much focus on speculation, incentives without fundamentals, and speed over substance. And also the social digital pressure to chase unsustainable yields. So, real estate is not sexy. Real estate is boring, right? So what's key here, people need to live somewhere. The buildings need to be built. The rents are paid. That we know. But it means that the yield is going to be a stable monthly yield, assuming that the actual infrastructure and the provider is above board and regulated and following. So on that side, chasing DeFi yield versus real estate yield, DeFi yield is sexy and fast, but dangerous and speculative. The Web3 community has to look at this from a perspective of saying, well, I view tokenized real estate or RWA assets almost as if you want to look at a portfolio approach to your investment, as the bond component, or the slightly much more conservative component that's going to get you 6-7%, maybe depending. And if you put it into a staked yield, maybe slightly higher. And you know that that's the value of the underlying token is not going to go up and down as the crypto market goes up and down, but will go if there's a link to the asset, that payout to the asset will go with the value of the asset. So when they see that they're putting in their $1,000 and they're earning 7% every month, but crucially, they can get out of that token at some point, either when the asset owner sells the asset, or if there's a bid offer that can be repurchased. That is when I think Web3 investors will make the switch, because at the moment they're chasing a lot of financial noise and speculation, and they're getting hammered. And people will say, well, I'm happy to put in $200 because I think I'm going to make 1,000, but they don't end up making 1,000. So from our side, LANDHIVE's big key is saying, how do we, first of all, build that community? How do we deliver the message that we're delivering a standard token that will pay you X every month, and that there's an asset behind it that means your token's not going to go up and down? That's the message we've got to get across. And I don't want to go and say that we're educating, because that sounds really, we're not doing that. What we're trying to do is, first of all, earn the trust by giving them all the right information. What they make with that, what they do with that, is their decision. That is my take on the Web3 community. But I think the other thing which we're learning is that there's a huge community out there that is not just digital. These guys are the traditional guys that go to the brokers. For example, in Switzerland, there's a lot of investment into these crowdfunding platforms where they'll buy shares in the company that then goes and invests in tokenized assets. It's based on, again, the credibility of the company that they're investing in. But that is a potentially massive market if you can actually, first of all, prove that you're credible, and secondly, show that you're giving them higher returns because they would not normally have invested in those tokenized assets. So that's a second component to the Web3 as a potential market for RWAs.
Could you elaborate on that model? Are you saying that these are fund managers that are including digital assets in their portfolio, and some of the more traditional players like that, it's like light exposure as opposed to them holding it directly? Or maybe I'm totally misunderstanding.
No, you're not. There's two angles to this. For example, there's a company in Switzerland called Gen2 that they're calling it an assetization. They're not digitizing these assets, but they are splitting them into 100 or 2. They're fractionalizing the assets. They would be building a hotel, and then they would issue a bond, and they'd take the bond and they would split it into 1,000 components, and the investors, through their brokers, will buy those notes, and in the end, it's backed by an asset. That's already happening.
Mm-hmm.
The next step is to say, okay, rather than just buying that, you could actually buy a digital representation of that bond, and that token could be held in your wallet if you generate a wallet. But if you're not digital, individual investors will go and buy shares in these companies that would then go and invest in these various projects. And those shares they can hold, and those shares can also be sold. So that's maybe unique to Switzerland in terms of this culture here, but it is creating a very dynamic market where those traditional investors are bridging into this fractionalized and then digital market.
Got it.
Does that answer that?
It does. Yes. So as we approach the end here, I want to give you an opportunity to talk about LANDHIVE. How did the company come together? How's it going? What are you looking to change in the industry?
That's always a good one. So the company, we've been going now for 2.5 years. My co-founders in the UK, we have our marketing is actually being done remotely, and I'm based here. We've got a partnership with Block Square. We have a certified marketplace in Luxembourg. We've managed apartments for a development that I actually was involved with and part own and we use that as a test case. We also have set up a staking platform within the Block Square network on the Ocean Point DAO, so you can stake your tokens. At this stage, our objective is we want to make investing in real estate as simple as transferring money, say on Wise. If you went back to wiring money in the 70s, how difficult that was, we want to get to the point now where the infrastructure can be used to create that. So that's our focus. We will be adding investment to fund developments, and these would mostly be structured as debt tokens. That's our next component. And from that, we will most probably be going down the road of potentially a utility token at some stage to facilitate those transactions. But we see the next 12 months as DeFi as the destination. It's not the shortcut. We want to get to a situation where the real assets are basically headed there, backed by buildings, real yields, and real infrastructure first. But we want to get to a place where if you're investing in property one day, it feels as simple as moving money. And LANDHIVE wants to get that job done.
Amazing.
That's it.
Well said. Well, Jens, this has been a great conversation. I always appreciate a perspective from traditional finance because decentralized finance does not exist without that. For a long time, it's been treated as its own bubble, but really it's an evolution. So you have to understand where we're coming from, the history of these assets and the instruments, why they move the way that they do, why we have these intermediaries in place to properly innovate upon that. And it sounds like you're doing that and you have great partnerships. So again, wonderful insights. Where should folks get in touch with you? I have a few links to your social media. It looks like LinkedIn and Telegram that I'm going to drop in the show notes so people can go there. Is there anywhere else that people should keep an eye on?
They can actually, thank you very much for having me, Matthew. And it's actually been very interesting getting from your perspective as well, because I know, if I look at your commentary online and you're very much focused on looking at the back end and looking at the foundations, which I think is kind of where we're coming from, and we're similar on that. For us, you can go on a LANDHIVE's website and you can register on our platform. You can you go through your KYC, and then you can access what the actual current assets are. But more importantly, then you're in the system and then you see all the new assets that are coming through. You can reach us on Telegram, or you can reach us through the through X. But ideally, go to our website, or come to us direct on LinkedIn if you need it. So it's been a pleasure speaking to you.
Yeah, wonderful, Jens. Thank you so much. I'm wishing you all the best on your journey.
Thanks very much, Matthew. Have a good day. All right.
You too.
Cheers.
Bye.
Bye.